Uninvested cash feels safe, but it's sitting in a hostile environment. Every day you wait to allocate your capital, it actively loses its purchasing power. While US economic growth hovers near 2%, headline inflation has accelerated to 4.2%. To fight this, the Federal Reserve's higher-for-longer strategy pushes borrowing costs up, cementing mortgage rates above 6%. Leaving your savings in a standard bank account right now mathematically guarantees a loss. Cash yields cannot keep pace with the rising cost of gasoline, housing, and everyday groceries. The instinct is to swing the other way and dump your money into today's tech giants. But picking individual stocks exposes you to severe concentration risk. If a single CEO missteps or a flagship product fails unexpectedly, your entire concentrated portfolio takes a direct, devastating hit. Surviving this specific economic setup requires a structural defense. You need a vehicle that shields your capital from erosion without forcing you to gamble on individual winners. That defense mechanism is the exchange-traded fund. It is the most mathematically efficient tool a beginner can use to compound capital over decades. Instead of buying one company, an ETF pools your money to buy dozens, hundreds, or even thousands of stocks at once. If one company in that basket fails, the impact on your total investment is negligible. The defining factor is the expense ratio. This graph shows identical investments diverging over 30 years due to a tiny fee difference. That growing red gap represents the drag of fund fees, silently stripping thousands of dollars from your long-term wealth. Combine that unnecessary fee drag with a 4.2% inflation rate, and a poorly optimized portfolio quietly suffocates your wealth. This table compares S&P 500 trackers, SPY, VOO, and SPMYN. SPMY charges significantly more due to its older unit investment trust structure. It cannot legally reinvest dividends, leaving cash idle. VOO and SPYM are modern open-end funds that immediately loop money back to keep growing. That older legal framework also blocks SPY from lending out its shares to institutional borrowers. Modern funds use the fees generated from securities lending to offset their own operational costs. VOO and SPYM bypass these structural roadblocks entirely. And for the lowest possible barrier to entry, SPYM charges just 2 basis points. Paying a premium for SPY's brand name liquidity is an unforced mathematical error. For a long-term holder, the modern open-end structure guarantees higher net efficiency. Once you lock in a core domestic fund, you have to determine how much of your money actually goes into it versus international equities and fixed income bonds. The traditional rule of 100 for a 45-year-old allocates 55% to stocks and 45% to bonds. But with 4.2% inflation, those bonds lose purchasing power. Moderate strategists suggest the rule of 110, increasing equity growth allocation to 65%. Keeping a larger slice of your capital in broad market and international equities deeper into your midlife years gives your portfolio the aggressive engine it needs to stay ahead of inflation. The remaining fixed income slice, typically held in a broad index like BND, provides a reliable yield ballast. Just remember that passive bond funds are market value weighted, meaning they are forced to hold the debt of the last borrowers, regardless of their credit quality. Adopting the rule of 110 requires you to accept slightly higher volatility in your 40s and 50s, but it is a necessary trade-off to defend your long-term buying power. For investors who want to actively adjust that balance, the core and satellite model keeps the bulk of your money in broad market indexes while allocating a small percentage to specific tactical trends. Adding a satellite like QQQM concentrates a portion of your exposure directly into the top 100 non-financial companies on the Nasdaq, targeting artificial intelligence and tech infrastructure. Alternatively, a fund like SCHD anchors the portfolio by targeting companies with 10 consecutive years of dividend payments, prioritizing defensive cash flow. The trade-off here is maintenance. These satellites introduce targeted risk, and if one sector takes off, it will severely warp your intended allocation over time. To prevent drift, use the strategic contribution method. Instead of selling the oversized asset, you direct all new incoming cash toward the underweighted segments. By funneling deposits into lagging assets, you organically inflate them until the portfolio returns to symmetrical alignment. This strategy protects you from generating taxable events. You never sell your outperforming assets, avoiding capital gains taxes and minimizing transaction costs. Tactical optimization and satellite funds can boost returns, but they are only mathematically viable if you commit to this level of rigorous, tax-efficient rebalancing. This chart maps exactly how to match a 2026 portfolio strategy to your habits. The first question is whether you want zero maintenance. If you want a completely hands-off approach, it routes you to a target date fund like ITDJ. You'll pay a slightly higher fee, but it automatically manages risk, shifting from stocks to bonds as you age. If you're willing to do basic annual maintenance, the flowchart routes you to the standard 3-fund core. Applying the rule of 110 to SPYM, international equities, and domestic bonds drives your expense ratio to near zero, but requires physical rebalancing. Finally, if you want maximum performance premiums and tight sector control, you reach the factor and satellite setup. This setup is reserved exclusively for the disciplined optimizer, someone who will rigidly execute the tax-free strategic contribution method with every single paycheck. You must be brutally honest with yourself about your personal habits. Adopting a highly optimized, complex portfolio structure that you eventually neglect is far more dangerous than simply buying a basic automated fund. True long-term investing is about maintaining steady, forward momentum, deliberately pushing through periods of intense economic friction and uncertainty. Sitting still and holding uninvested cash in a 4.2% inflationary environment is not playing it safe. It mathematically guarantees the slow, silent erosion of your long-term wealth. Thriving in the 2026 economy doesn't require you to outsmart the market. It requires selecting a highly efficient structural defense, matching it to your personal discipline, and let the math of continuous compounding do the heavy lifting.